It's 2023 and the Fed is officially trapped between a rock and a hard place, as they say. Let's quickly recap what the Fed did in 2022 to attempt to fight off the upwards of 9% inflation rate that we've seen. The Federal Reserve raised federal funding rate 7 times in 2022, including 4 increases of 75 basis points. The benchmark overnight bank borrowing rate, which started the year at a target range of 0 to 0.25%, ended the year at a target range of 4.25 to 4.5%. Both the Federal Reserve and the market more broadly suggest that the Fed will continue to raise the federal funding rates in 2023, possibly 2 to 3 more times until a terminal rate of 5 to 5.25% is reached. The terminal rate could stay in place for all of 2023, with forward indicators again not suggesting a decrease in the federal funding rate until 2024. The Federal Reserve will continue to reduce the size of its balance sheet by around $95 billion per month in the meantime. See, the issue is bigger than that though, because you see both the Fed and Washington are constantly working off of flawed models and downright wrong data. Let me explain. The first thing you need to know about the data that is released by the Fed or any other government branch is that it's usually delayed. It's delayed by anywhere from 30 days, if you're lucky, to 12 months. But the average is about 1 fiscal quarter though. Go see it for yourself. Head on over to the St. Louis Fed. They publish the FRED data sets and see how much of the data is actually up to date. Go ahead, I'll wait. The only way for the public to get the most up-to-date data is to take the CSV data sets that they release on their sites and then plot that out and track it yourself, or pay for a third-party service to give you a closer to real-time amount of updates. That makes this data that they release and the media splashes all over the internet, CPI being the big one, nearly worthless because it's always looking back in time. It's not looking at where we are at right now. So the big question is, why do they delay the data so much, giving Americans a false sense of where the economy is? It also means that the Fed makes interest rate policy changes based on this, bailouts are spun up based on this, and so is government policy, all based on these delayed and oftentimes flawed models and data sets. Crazy, right? Now I know what you're thinking. The Fed must be working off of additional data sets and models. They can't just be working off of what us peasants get, right? More on that in a minute. I want to share with you a small sampling of how just 3 pieces of wrong data in 2022 led the Fed down the path of raising rates over 200 basis points, when in fact the economy had already cooled and they should have probably stopped raising rates. Now, between February and December of 2022, the Fed went from about 0.25% interest rate up until now we're at 4.5% interest rate. Let's start with CPI. The Fed looks at CPI data to make its interest rate hike and cut decisions, yet inside the CPI model itself, there's a huge flaw. Well, it turns out there's many flaws. We actually covered some of those in a recent video on the channel. There's a flaw that we want to focus on in this video within the CPI model, which is the shelter portion of the model itself. The Bureau of Labor Statistics, BLS, category for shelter accounts for 32.77% of the CPI index, and that's broken down into the OER or home owners equivalent rent, which is at 23.68%, and rent of primary residency at 7.8%. Here's the issue. Did you know they use a data set called the All Renter Index, which is based on data from all renters, not just new renters, and includes rollovers of historical rents? And guess what? There's a 12-month lag in that data set. Yes, you heard that correct. There is a 365-day lag in essentially 1/3 of the model that they use to make interest rate decisions right now. Recently, researchers at the Federal Reserve Bank of Cleveland and the Bureau of Labor Statistics built an index that's based only on the leases of tenants who recently moved in, a shortcut meant to avoid the traditional lag in the CPI's historic rent metrics, and compared it with the conventional measure which looks at the average of rents for all tenants. And I quote, "We create new indices from Bureau of Labor Statistics rent microdata using a repeat rent index methodology and show that this discrepancy is almost entirely explained by differences in rent growth for new tenants relative to the average rent growth for all tenants. Rent inflation for new tenants leads the official BLS rent inflation by 4 quarters. As rent is the largest component of the consumer price index, this has implications for our understanding of aggregate inflation dynamics and guiding monetary policy." The researchers cited an ongoing debate whether the headline inflation numbers should use housing data based on the entire rental market or new tenants only. The former covers the financial experience of a much wider range of people, while the latter is better at capturing the latest shifts in market prices. Put another way, the new tenant repeat rent index uses the same microdata that goes into the official CPI to select only samples with rental turnover and to assign price shifts to when they happened, not when the units were surveyed. The new tenant repeat rent index therefore leads official inflation data in the CPI by 1 year. Here's a look at how the two compare. Kind of interesting that the Fed is now just discovering this when in fact Goldman Sachs made the index and rolled it out a few months ago. With this new data set included into the CPI modeling, it would push inflation much lower, which again would affect Fed interest rate policy decisions. They are once again raising rates into a massively cooled off economy. Does this sound familiar? Next, let's look at another piece that came out before the rent index bombshell, and that is the Philly Fed revising job numbers. The Philadelphia Fed effectively revised what was, according to the BLS, a gain of 1.1 million jobs to just 10,500 jobs between the period of March to June of 2022, meaning that the Fed was looking at erroneously overstated, arguably politicized data, because remember the midterms that just happened, as it unleashed its fury on a 75 basis point rate hike in June, which happened just as June job numbers turned negative. Here's a look at the published report. Even Bloomberg admitted that the Fed may be working off bad data. Remember, when the Fed raises interest rates, it makes all debt out there harder to pay off. Prime rates go up, and people pay out more in interest on everything from loans to credit cards. How about we now put the nail in the coffin by finally answering the elusive question, is the US in a recession? Here's what the St. Louis Fed researchers Cleason and Marks found in a report published just a few days before New Year's Eve. Of course, a time when absolutely nobody would have noticed a shocking admission that the US is in a recession. In a report titled, Are State Economic Conditions a Harbinger of a National Recession? Economists view recessions as national events. However, past recessions have shown that some states' economies continue to expand during a recession, particularly when the national recession was relatively mild. The Federal Reserve Bank of Philadelphia's State Coincident Indexes, SCIs, can be used to assess whether recession-like conditions have developed in each of the states. And if so, whether there is a threshold in the number of states that might signal a national recession. This chart plots for each month the number of states that had negative month-over-month growth based on this index. The figure shows that the series has favorable recession indicator properties. That is, during national recessions as defined by the National Bureau of Economic Research, NBER, the number of states that register negative growth in the SCI increases. Here is a number of states that had negative SCI growth at the start of these 6 recessions. February 1980, there was 30 states. August 1981, 30 states. August 1990, 26 states. April 2001, 24 states. January 2008, 9 states. Cover that more in just a second. March 2020, 35 states. The average is 26 states. Now, let's cover this 2008 anomaly really quick. The 2008 recession is a clear outlier. The likely reason is that it was unclear at the time that the economy had entered a recession due to, again, massive delays in economic modeling. In 2008, the advanced estimate showed that real GDP increased at a 3.2% annual rate in the first quarter of 2008. By the time the third estimate released in June 2008, first quarter growth was revised up to 3.7%. Likewise, the advanced estimate for second quarter real GDP growth was 1.9%, which was subsequently revised to 2.8%. The current estimates that reflect all subsequent revisions of 2008 numbers show that the real GDP declined at a 1.6% rate in the first quarter, but increased at a 2.3% rate in the fourth quarter. So that's a pretty strong economy. It was not until the failure of Lehman Brothers in September 2008, which triggered a sharp decline in equity prices and an economy-wide plunge in economic activity, that most economists viewed a recession as highly likely. By October 2008, 47 states registered negative SCI growth. The report goes on to rhetorically ask in a final section, is the US tipping into a recession? In summary, a threshold estimate based on the analysis shows that 26 states need to have negative growth in the SCI to have reasonable confidence that the national economy entered into a recession. Excluding the 2008 outlier raises the threshold to 29 states. So, where are we now? In October of 2022, 27 states had negative growth in the SCI that would exceed the 6 recession average of 26 states, but would fall short of the outlier adjusted estimate, which includes 2008, of 29 states. Their unstated answer was yes, we're in a recession. So let's recap real quick. The Philadelphia Fed admitted over 1 million jobs created in quarter 2 never actually happened. Next, the Cleveland Fed admitted core CPI is far lower than what the BLS reports and what the Fed feeds into its models, creating policy. And lastly, the St. Louis Fed is effectively saying that based on the number of states with negative growth, the US is effectively in a recession. As I mentioned in the beginning of this, I assume the Fed and other government bodies are working off of additional data sets and models, right? Let's hope so. If they are, though, it's all clearly pointing to the same conclusion, that they are quickly getting more and more stuck. So, serious question, what is the Fed supposed to do now? Let's dive deeper into just what got us here. We have decades of ultra-low interest rates, which pushed capital into the financial markets. It did so at the expense of future economic growth, creating large amounts of debt and now dependency on low rates. The dependency becomes larger and larger just to keep up with the normal living standards. See, contrary to popular belief, monetary policy does not create self-sustaining economic growth. So ever larger amounts of liquidity are needed to maintain the same level of activity, creating future forward drag. It currently requires $4.82 of debt for each dollar of inflation-adjusted economic growth, as you can see in the chart in front of you. Next, decades of money printing, with the crescendo being 40% of the total M2 money supply being pumped out into markets in about the duration of just 15 months during the pandemic. Just a quick note here, very little of this is actually printed, even though we say quote unquote money printing. It's more so promissory notes, digital debt, etc., and it's included in the overall M2 money supply numbers. Decades of cheap money made companies lazy on innovation, further pushed more outsourcing into emerging markets to increase margins. Accountability has dropped as balance sheets grew, because again, who cares? Money's too cheap not to go back and get another round of funding. We can keep going on this, but I think you get the point. No matter how high markets pump or system leverage increases, at some point the music stops and we see what's called a mean reversion. This is when markets come back down to the average or the mean, and that means it's a long way down from our current interest rate of almost 5%. I'm sure you've heard people mention soft landing. What they're referring to is the Fed's ability to bring us back down to their target mandate of 2% inflation. Unless, of course, we just throw that out the window and change that mandate. Well, recently, there was an interesting article quoting both a Biden staffer and a former chief economist for the IMF who suggested that we just abandon the 2% mandate altogether for a quote-unquote more realistic 3 to 4%. So that's one option that's on the table. Next, we've got James Bullard, the president of the St. Louis Federal Reserve, who suggested the central banks might need to employ the quote-unquote 7% solution to ensure the complete destruction of inflation. Now, the 7% solution means raising rates 2.5% to hit that 7% interest rate. I'm sure he's right, and it would effectively stomp out all inflation. The only issue is that such a large jump with so much debt out there that surely something would break, and we would probably see a catastrophic, long-lasting recession. We can actually look back at the policy errors of the 1970s as reference in this case, with one key difference. 2020 inflation was the result of a one-time artificial influence versus the 1970s, which was a steady buildup of inflation long before the Arab oil embargo. Economic growth, wages, and savings rates catalyzed demand-push inflation. In other words, as economic growth increased, economic demand led to higher prices and wages. Furthermore, the government ran no deficit, and household debt to net worth was about 60%. So while inflation was increasing and interest rates rose in tandem, the average household could sustain their living standard. This next chart shows the difference between household debt versus incomes in the pre- and post-financialization eras. I know it's a little bit small, but hopefully you can catch the drift. What was the most notable is that the Fed's inflation fight didn't start in 1980, but persisted through the entirety of the 60s and the 70s before even getting to the 1980s. As shown, as economic growth expanded, increasing wages and savings, the entire period was marked by inflation surges. Repeatedly, the Fed took action to slow inflationary measures, which resulted in repeated market and economic downturns. They're all going to be queued out on the chart in front of you. So what's the problem today? The problem is the massive debt levels provide the single most significant risk and challenge to the Federal Reserve right now. It is also why the Fed is desperate to return inflation to low levels, even if it means weaker economic growth. Jerome Powell recently stated the same, and I quote, "We need to act now, forthrightly, strongly, as we have been doing. It is very important that inflation expectations remain anchored. What we hope to achieve is a period of growth below trend." That last sentence is the most important because the Fed is already behind of most of the economic activity projections, and now they're talking about slowing economic activity further, all in this fight on inflation, as you can see from this chart. The reason that slowing economic growth and killing inflation is critical to the Fed is due to the massive amount of leverage out there in the economy right now. Here's that chart again showing you the system leverage against the total GDP. That's a big gap. The real problem comes if inflation remains elevated and interest rates adjust to higher levels, and that remains for a longer period of time. That's when we start to see trouble. That would trigger a debt crisis as servicing requirements increase and defaults will rise. Historically, such events led to a recession at best and a financial crisis at worst. Here's a chart to show you that. It's clear to see that the Fed is walking a tightrope here, and we are all hoping that they play this right and play this perfectly and do not blow up the economy. It's also clear that the Fed at some point will have no choice but to pivot on its policy and start easing sooner versus later to offset the deflation of assets. Now, I'd love to hear your thoughts in the comments below. Thank you so much for watching. Share this with a friend or somebody that you think might need to hear it. Stay tuned for the next one.